We have startups that have gone from their seed financing to being acquired in 8 months. No one is really even thinking about an IPO.
Hi, I'm Ed D'Agostino, and today we take a look at how AI is upending the world of venture capital. My guest is Stephen Lord, Chief Operating Officer at Burkland Associates, providing fractional CFO services to hundreds of VC-backed firms. If you want to know more about the world of venture capital, its impact on our daily lives, and where capital is flowing today, this episode is for you. Stick around to the end, where Steve gives his best advice for company founders and for anyone thinking about making a venture capital investment. Thanks for joining us here this week at Global Macro Update. Steve Lord, old friend of mine, it's great to see you. Thanks for taking some time out of your busy venture capital packed day.
Absolutely. Glad to be here.
Let's start with that, right? What is the state of venture capital today? Is it raining money? Are deals still getting done? Where are we at?
So it's not raining money. Deals still are getting done. But I would think if there's a way to characterize it, it's a little bit more of the same. We've been in a bit of a pattern for the last couple of years, really, where deals are harder to get done unless you have AI in your business plan somewhere. Valuations are pressed. Founders have a harder time raising successive rounds. Existing portfolio companies are under a profitability pressure, which is different than it was maybe pre-pandemic. And there just seems to be a general, lack of velocity is perhaps the right way to put it. Startups used to be able to go from, seed to Series A to Series B, maybe a B plus, maybe a little venture debt in there along the way, all within 24 or 36 months. And that timeline has stretched, and it remains stretched, which is why a lot of these startups are really struggling to bridge gaps from one funding round to the other.
Why is that? Is it cyclical, or is it a reflection of the market tightening up, the public market tightening up a little bit around tech?
There's not one particular answer to that in my view. I think there's a lot of things contributing to it. The IPO market being a little quiet is obviously, or a lot quiet is a big factor in that. There just also isn't the exit velocity that a lot of these companies would have maybe had in prior eras. There is definitely a cyclical element to it. When you actually chart it out, VC and interest rates are fairly well correlated, right? So we did have a bit of a spike in rates, relatively speaking. And everybody harkens back to the good old days of 2014, 15, 16 and say that was this heyday of VC. But what they forget was we had zero interest rates then. Capital was free. So of course there was a lot of deals getting done because money needed to find a home. Now, even though it's low, even the 10-year treasuries at 4%, you and I remember back in the day when treasury bonds were 7 or 8%, right? And we thought that was low. But it is still a competitive capital market alternative, maybe, from the VC particularly, and even the growth PE markets, where you have to expect capital is going to be stuck for several years before you see a return.
When you and I were in college, right? Like everyone wanted to grow up to be
1820, 1830.
Everyone wanted to be a hedge fund manager, right?
Correct.
When they grew up. And some of our buddies were. And it's interesting what's happened to that industry. I'm wondering if there's a parallel, right? Like today, from what I understand in the hedge fund world, it's really, really hard to raise money. And all the money goes to the biggest firms. If you're Steve Cohen, no problem. But everyone else, it's almost impossible to get sponsorship. Is that happening in the VC world as well?
Yeah, it is. A lot of capital is going to the biggest firms. I think there's a little bit of a wider distribution than maybe in hedge. Again, because the capital is locked up so much longer, private equity is largely the same. And we have more of a window into growth PE. These are the sort of smaller deal sizes from private equity, but they're not liquid. Hedge funds tend to be operating in much more liquid environments, right? So in that case, you've got this sort of reverse psychology effect going on where the less liquid of an investment tends to create, in some ways, almost like less trepidation. So it has happened, but it isn't, I don't think, quite as extreme as it is in the hedge fund world.
How many investments would you say the biggest firms have, like in Andreessen? How many companies are they invested in at any given time?
Hundreds and hundreds. I mean, they have so many different sleeves, so many different practice areas. They have specialty areas. They have a whole fintech division that's just focusing on fintech. They have obviously, any good VC these days, they have an AI team. So they're pretty aggressive, and they've got, I mean, I don't know the number, but I have no doubt that it's in the hundreds.
Your firm, Burkland, you service hundreds of VC-backed firms.
We do. Yeah.
So you've got a really big window to see this world through.
Yeah. And I think what's interesting is it is like a lot of these kinds of sectors, it is a network effect that happens there. We work with a new VC firm. When we do really well, we put a fractional CFO aboard. You know, the fractional CFO thing, the best way to sub that up is basically a VC firm writes a check into a company and they would like an adult in the room. That's the sort of easy way to summarize having a fractional CFO there. So if we do well, and we try very hard to do very well, then obviously we're a known quantity to that VC firm. And the next time they have a portfolio company that they want, you know, strong accounting and strong finance strategic advice, then they call us up. Most of our relationships generate our referrals. That's one of the key facets of our business, is that probably 70 to 80% of our inbound clients are from word of mouth from other VCs. So it is pretty clubby. That said, though, you know, you mentioned Andreessen. We work pretty closely with Andreessen, and we are one of many firms that they use. Like it is at that level, it is a pretty wide net. Then to also put the other side of the curve there are a lot of smaller firms with maybe 4 partners and a couple support staff. They have no way the bandwidth to help their clients or their portfolio companies with finance. And so, you know, we're a good option for them, or people like us.
If you see that big of a swath of the VC funded world across multiple firms as well, that's pretty unique. You mentioned AI, right? But buzzword number one that we're going to work into this interview, AI. So what's happening? What's the appetite for is AI backed companies? Are they sucking up all the oxygen in the room? How's it playing out? What do you see happening there?
They're definitely sucking up the oxygen in the room. They are, or rather that oxygen effect is beginning to, in my opinion, we're beginning to see something that we experienced in another life, where even companies that are not really AI in the sense of like a ChatGPT or a, you know, Gemini or one of these other ones, but they are trying to capitalize on that buzz, are trying to work AI into their business any way they can. So even if it's probably maybe just machine learning, or maybe it's just some sort of programmatic routine, now it's suddenly AI, right? And we saw this back in the day with the internet and all these other crazes that we've lived through. The difference here, and I'm one of these folks that is usually pretty skeptical, thank you, of anyone, you know, saying it's different this time, right? In this case, what I feel is a cardinal difference between the two is the compressed time. The iterative nature of the true AI startups is what's different. There is not this normal business cycle that we've experienced with other things. Like take the internet. We had the internet, but internet was gated by bandwidth, right? So it wasn't really going to go anywhere until bandwidth improved, computer technology was accessible. There was this sort of downshifting to a more egalitarian internet versus the folks that could put a T1 phone line into their building. AI is coming from the other angle. It started out egalitarian. You can go on to ChatGPT and use it for free, and every day it's learning and learning and learning and learning. So it's almost the reverse of the internet, right? So it is, to me, a cardinal difference, the speed with which these startups are moving. And you read a lot about that, but we see it with the startups. We have startups that have gone from their seed financing to being acquired by a, metascaler in 8 months.
Wow.
The intensity is there. The capital is there. Firms are willing to write big checks for just the teams. There have been a couple acqui-hires in this space as well, where you just have a team lifted out of another one, and lots of money, lots and lots of money. And an interesting thing about this too, different from back in the day, is at least from what we can see, very few people are even talking about going public. There is no one is, at least in what our view is, what we see, that's a distant conversation. No one is really even thinking about an IPO. It is all about capturing the brains, capturing the real estate in AI.
Is the exit strategy abandoned, or has it just changed completely?
It's become strategic versus financial. So, you may have a private equity exit. You may have folks trying to, set something up to be acquired by a KKR or one of these other really, really large PE firms. But by and large, I think many of the folks that we work with have their sights set on being bought by an industry strategic. So someone who's in that industry, a dominator perhaps in that industry, who isn't going to innovate as quickly in AI as a startup is. And instead of trying to build it out, they're just going to tuck it in. There's a crypto parallel here too. In the early days of crypto, a lot of companies were saying very much the same thing. And in many cases, it's exactly what's happened.
Well, and let's face it, right? Being public sucks. Right? It's just miserable.
Being public is hard. I ran a public company years ago, as you know, and I totally believe in the saying that when you run a public company, you go from spending 80% of your time running your business to 80% of your time talking to investors. The focus is off. Everything has changed. Nothing is what it used to be. It's very different.
Different. That's a very politically correct
political way of
diplomatic.
Yeah.
You're very diplomatic. Is AI disrupting the venture capital industry itself?
I think what it's doing, partially, yes. Operationally, sure. Companies are able to do a lot of due diligence faster. They're able to crunch a lot more numbers quicker. They used to have to maybe hire in MBAs and, junior analysts to run numbers and spreadsheets and all of that. And they can do an awful lot of that now, programmatically or using agentic routines, right? They can have a little sort of labor arbitrage there where they don't need as many costs on the GP. They can do a lot of the same work, run a lot more companies through the funnel. But where I think the real VC use for AI is in the portfolios. So there is really not many companies or startups that we see that, if they are not an AI company themselves, will be using it or will be disintermediated by it in the near future. Andreessen Horowitz, they had a saying several years ago that this is back when fintech was all the rage, every company is a fintech. They just didn't necessarily know it yet, right? But every company was going to be using Stripe or using QuickBooks Online for a lot of their work. Everybody was a fintech. They were going to clear through a neobank, right? Same thing here. You're going to be in one of these three camps. Either you are an AI company, you are using AI to dramatically change the way your company does what it does, or you're going to be one of these folks that gets disintermediated by the people who are. That's it, right? So it's factoring into how VCs are making portfolio decisions. Because remember, every time you think about a VC structure, you have to think that the horizon is 7 to 10 years. That's the outcome, right? These are not trades. These are investments, and they really want to make sure that they're putting their money in the right place.
What kind of impact do you see a company like NVIDIA having on the space, right? I mean, NVIDIA has its own venture capital arm. They deploy billions and billions and billions of dollars. They did over 100 deals already this year. Are they taking deals away, or are they careful to sort of, just be one of the guys at the table? How does that look?
They are similar to, and this can change, okay, because we are still early in a lot of this, so I don't want to, this is not necessarily going to be static. But they're taking a similar tack that a lot of the industry folks do, like in Intel or Google Ventures or any of these other. They do end up having a lot of excess cash. They do end up having a lot of use for these innovations, right? But what we've learned, what I've seen, and it's just me, right? But what I've seen is a lot of times the industry VC firms have a bit of a soda straw view of where that capital can go, what it can do, and who should they be talking to. And it makes perfect sense. They're coming from a very particular point of view on the industry. Take NVIDIA, their hardware, their chips, they're all over this, right? But that's only one facet of the overall revolution, if you will. Using crypto again, back in the day, we had a lot of finance firms that were starting up venture arms to go out and invest into crypto. Well, turns out most of them were doing what they were trying to figure out a way to make crypto do what they were already doing, right? Say MasterCard. It's a good example, right? So the risk is potentially that, well, it's not a risk. The factor that may play a role there is that they don't have as wide of an aperture, in terms of what deals they're going to look at, where they're going to play and where they're not going to play. You have a company like an NVIDIA. It's unlikely that they're going to go now and invest in a firm that uses AI for sound effect optimization for movie studios, right? I mean, they might. I'm not saying they won't do that, but their worldview is probably not starting out there.
You brought up crypto a few times. And you, earlier than anyone else that I know, probably 10 years ago, we have proof, like we have you on video at Malden Economics saying, get your Bitcoins.
That's right.
And I think Bitcoin was like $200 a coin.
$300, something like that.
I mean, coulda, shoulda, woulda. I'm still working today, Steve, because I didn't listen to you.
Well, I'm one of these folks that if I'd kept all the crypto I had at one point, you and I would probably also know, or I'd be calling you from my island, but we're also of a generation when you got 3, 4, 5, 6 times your money, you tended to take it, right?
Yes,
it's all right. The therapy will help both.
Well, you know what? Our generation, Gen X, was scarred from from the great financial crisis and prior to that, just as we were coming into the workforce, right, was the dot-com bubble.
The dot-com crash. Yeah.
So you're steering a 5 or 6 bagger in the face. You take it.
You tended to take it, especially at the age we were at. Yeah. Crypto has been obviously a huge roller coaster, and there are still significant corners of that market which need, advancement or I guess iteration, maybe maturation. But it's definitely here to stay. It's shown resiliency. It's getting its teeth kicked in right now at the moment, but I'm pretty confident that will be a phase like all of this tends to be. One of the things, because we were talking about macro earlier, one of the things that I think is so fascinating with crypto is it was born out of that financial crisis. It was born out of a desire to create something that was immune to macro swings and, centralized finance, banks going out of business and all that. I mean, that's what it was created to avoid. And now we've advanced, quote, quote, to a place where macroeconomics is impacting crypto probably more than anything else, right? It's become an asset class. Institutional investors are all over it now. People are trying to use it to hedge things. It's still not liquid enough to really do that, but people are trying to do that anyway. Super volatile. So in a way, it's become the thing it was trying to replace, right? Which is fascinating to me.
Has it evolved in a way that you feel it's starting to touch everyday life for a non-crypto bro, so to speak?
Yes, but I think that adoption has been slower than a lot of people thought. Most people have been touched by it because they've tried to speculate in it. That's, I think, probably if we could take a very unscientific poll, that would be what most interaction has been. For a while, there was a real push in startup land, which Burkland was working on, to utilize blockchain technology to do something in the back office faster and more accurately. Right, which to me, back in the day when we were on back in the original crypto interview, that was always the use case I thought was going to happen. I never really believed that people were going to use Bitcoin to buy coffee at Starbucks, right? But that Starbucks might clear that cash instantaneously using a blockchain of some kind, I felt like that was a fairly reasonable use case. That has taken longer than I think anybody thought. You have a lot of very robust blockchains out there. You have a lot of really, much more capable ones than the Bitcoin blockchain. But they do exist in the back end of an awful lot of companies that are trying to use blockchain to do, candidate screening and processing payments, right? So how is it touching people? I think it's, like I said, it's taken longer than we thought. But where it is beginning to become apparent is if you're using an ATS, if you're trying to apply for a job, if you are, using like a gift card to buy something online, there is a chance at least that the payment processor that firm or that site is using is going into a blockchain and then back out again to process the cash, right? Some of the sort of nirvana things that I thought would have happened by now was, like equities, securities trading still settles very slowly relative to what the blockchain could be, or a blockchain could be doing for them. And it's a mix of things. It's a lot of entrenched interests. It's a lot of cost. That's keeping a lot of people's houses warm in the winter. I don't think there's been the firepower there.
I literally just wrote down interests ? Because, you look at things like title insurance, right? Like, why does that industry still exist? That should all just happen instantaneously on a blockchain.
Should be an immutable ledger. You can't hack it. You can't fake it. It's either there or it's not. Yeah. Look, crypto also, it's the best and the worst of people, right? Because it's also still struggling with this reputation of illicit money and, manipulation, fraud, all sorts of stuff. And we struggled with that even at Burkland. We had founders coming to us and, not wanting to use their real name on their tax return. And we would have to be like, yeah, that doesn't really work here. And so, you wouldn't believe some of the conversations. So that has obviously not helped in any way, the adoption of what could have and may still be a very capable leg of the stool, just functionally. Leave all the speculation out of it. Just getting things done more accurately, more quickly is still the promise there, I think.
So what do you think's the next big thing? You're at the cutting edge, literally the bleeding edge of technology development. Is it quantum computing? Is it humanoid robots? Like what do you see coming down the pike that maybe isn't in the general conversation yet?
You mentioned quantum. I think that's an interesting area because now, at least since I've been paying attention to it, there is actually something that could use the firepower, right? We are going to have a power problem with AI long before we have a Terminator type scenario where the robots are shooting us, right? We are not going to be able to generate the power necessary to put all this stuff into motion, right? So that's where I think some of this needs real thought and real investment. And quantum computing offers, if I understand it, which I don't profess to really being able to do, but if I understand it right, almost an exponential step up in computing power, right? Which is, we will need that if we even hope to do what we want to do with AI, given the power constraints we have. So actually, I think before AI really becomes ubiquitous, sort of like the internet has become, we're going to have to solve that power problem, and quantum might be one of the ways to do it.
It's the equivalent of the T1 line that you mentioned with, the internet.
And I think it's the only way that you're going to get the real, curve steepening, because we will have capacity problems. I mean, we're already talking to firms that are trying to, get into the micro nuclear reactor business. There's several already out there doing this. DoD is looking at it, right? Because ChatGPT, tell me the best way to say happy birthday to my mother. That use of ChatGPT is not even close to the real action, right? The DoD, the Chinese, there are a lot of geopolitical folks that are looking at rivals, really, that are looking at this too, all of whom need power. And interestingly, you need it to be secure power, right? And anyone who's looked at the U.S. power grid knows that that's kind of not there yet. So DoD looking at some of these micro reactors, and even commercial firms, Amazon, Microsoft, looking at captive micro reactors makes sense when you realize what they're trying to run.
When you say micro reactors, are you going one notch below small modular reactors, or are we talking about the same thing?
No, I think we're saying the same thing, the small modular ones. Yeah. And I may not get this right, so for everybody who's going to look this up after I say it, I apologize. But I think I saw some statistic fly by that. I think I read that the AI power farms, the AI firms or the server farms in, I think it was Wyoming, already account for more power than the people who live in the state of Wyoming.
That's a problem that I have to think is going to get fixed at some point, right? I mean, Google's shot across the bow recently that, hey, our chips use a lot less power than NVIDIA's. When your problem is that big, someone's going to fix it, right?
Right. And it probably won't be one thing. Like you said, it could be a combo of the chip design. It could be the power. It could be quantum computing that gives us a lot more bang for our buck. It may be all three, but I do think that one of everyone's, worried AI is going to take my job and we're all going to be, in the matrix in 2 years. I think we're going to have to solve this stuff first before we can get there, or we will get there rather.
I agree. At some point, people are going to rise up and say, my electric bill's gone up 10x and I could care less about AI. I just lost my job and I'm angry. Right? Like that's going to come if we don't figure this out.
That is actually, when you look at the societal impacts of innovations like this, we've seen versions of this movie before, and that's also in the cards if we aren't careful, right? Because there's an awful lot of middle tier executive talent that is going to have a problem. And we talk a lot about this internally. If you are in a service industry, and you say bill by the hour, or you are in some sort of deliverable type industry as a professional service, and you are not on your front foot with this stuff, you are in trouble. So you don't want to be the horse and buggy maker watching the cars drive by, right? So and in a way for the economy, this is an important thing too, since we're talking macro. Every one of these innovations, and you can count even things like email in them, right? Because we both remember the day when, you didn't have that. It wasn't a thing.
Yeah. I do remember that, sadly.
Is the gain in, this is actually really important, the gain in productivity that will start to appear if we're measuring it right, and the BLS is open and all that stuff. The gain in productivity that AI offers is off the charts. And that will have implications for monetary policy, for tax policy, for social programs, social nets, all of that, right? I'll give you an example. In our world, we do a lot of pivot tables in Excel and in Google Sheets, right? And the AI that Google has now embedded in Sheets, I was playing with it a couple of weeks ago, and it created a pivot table that would have, and I'm pretty good in that domain. It did a pivot table for me in 10 seconds that would have probably taken me an hour or two to actually get correct, right? To remember the formulas, to put them in right. Is it double quotes? Is it single quotes? Is there a space there, right? That is a big deal. And so I'm hopeful, the optimist side of this is the productivity gains will be massive. And every time that has happened in the past, all the way back to the steam engine, it has related in a better, bigger, higher tide that everyone benefits from.
The pie gets bigger. So
Correct. You move the circle outward a little bit more, right? And we have a lot more time to think about all these innovations, like how do we get the cost of the chips down?
So do you think the United States still has an edge in all of this? Is Silicon Valley still the secret weapon of the U.S., this ingenuity engine and this almost infinite bucket of money that seems to be able to fund new ideas? Do we still have that edge, or are there models out there that are threatening the U.S.'s dominance?
I'll answer the first one with a bit of an anecdote. I am never more encouraged, and my faith in the country's future is never more restored than when I'm working with the startups that we have as clients at Burkland. These are super smart folks. They're working on really cool stuff. They are changing the world. They're trying to create a better world for themselves and all of us every day. So I am usually, that's the best part of the job, is actually hearing and dealing with that kind of energy and optimism and integrity, and all of that is really, really, really encouraging. And what I think we risk the most is that the capital and things like AI allow this ingenuity to be emulated quickly and easily. You take a country like China, which I know is a topic all the time, right? They actually copy really well. Right?
Yes.
So what we see is, before it used to take them 4 or 5 years to copy something really well. Now it might take them 6 months to copy it really well, right? And so I think the ingenuity here, the innovation here, the capital infrastructure, and this is an important point, the efficiency with which we insist that capital is utilized is also a competitive advantage for the United States, right? Is there. I'm firmly convinced in that. I would never, ever, ever bet against that. And the distance or the gap between us and the next guy is getting smaller because of the ability for other countries to throw money at things and emulate what they're seeing being done here.
Yeah, and it's not just China, right? I mean, you're seeing the Middle East getting in on AI in a big way. In any country that produces more engineers than attorneys, probably has, and I say this as a father of an attorney, but the reality is we've got a lot of them. We probably need more engineers.
I think we should be all careful too, not to discount the systems in which these things are swimming, right? So when you're flying an airplane, you're going down and you are a product of the air around the plane, right? For good or for worse. It's really nice out. It's great. If it's not, it's bumpy, but whatever, you are being impacted by the ecosystem around you. And that plays a role in what you just said. Middle East is a good example, right? These are places where they got all the money in the world, but they don't have an entrepreneurial culture yet. Right? They have a very top-down, China's the same way, very top-down, very command line almost environment, right? Still, that does not generate the kind of, I'll use that word again, velocity like we have in the States. As you recall, I lived overseas a long, long time, right? And I lived in Germany, and I tried very hard to start 3 different companies there. And when I was there, I realized that you can start a company in Germany any day of the week you want, as long as you had $50,000 in capital. You had a notary sign off on your formation documents. You had all this work done. You had to have this many employees and this much there. You had to have an address, right? All of these things were in the way of you starting a company, but we did it. And then we put an ad in the newspaper that said our prices were cheaper than those guys. And those guys at the time were Deutsche Bank. And the next morning, we were sued for unfair competition by Deutsche Bank because we were a 3-man startup, literally using a computer on a door. That culture that is what I mean when I'm saying that the ecosystem matters. You can have the most environmentally conducive thing in the world, and a good idea will still get traction. If you don't have a conducive environment, the most brilliant entrepreneur on the planet will probably stay with Siemens and give his idea to the company they work for versus start their own. And that, I think, plays a big role in places like China, in the Middle East, even in Europe to some extent still.
Yeah, I have lots of European friends who are trying to come here for that very reason.
It's hard. I lived it. It is very hard to start a company over there. And it's hard to even keep it going. It's hard to be a consumer. There are all these things in the way. Now, the flip side of that is people say, well, yes, but it's a very socially aware area and the healthcare is good. And all of that is true. But when you look at it just through the soda straw of entrepreneurialism and the velocity of startup creation, there's no place on the planet like America. Not yet.
Okay, so let's wrap this up. A couple of advice points. What is your advice for a founder today, given the backdrop that we just covered over the last 40 minutes? What would you say to a founder looking to raise money right now?
Start early. Don't be discouraged. You may need to knock on 200 doors, but don't be discouraged. Keep going. Just don't stop. There is money out there. The last thing I would say is make sure your story is tight. Make sure you're realistic in what valuation you think you're going to get. Your idea may be the most important thing in the world to you, and it may be the thing that changes the world. But no one knows that's really going to happen yet except you. So don't expect the world to give you a $100 million valuation when it's you and your best friend, right? Be realistic in what the VC is going to want in return for their capital. And like I said, have your act together. Don't try to bro it. Sometimes we have founders that are trying to bro it and they're trying to be cool and they don't want to seem like that guy. Well, you know what? VCs care a lot about how put together you are and whether or not you can actually put your vision into reality. So be buttoned up, have answers to questions, think about it. Don't just go and, oh, look, man, I'd really like to raise some money, man. Some of the guys can get away with that, but even the ones, I'll say this too, even the ones that profess to be super chill, in my experience with those founders, you scrape that away a little bit, and those are some pretty wired down, pretty intense, pretty buttoned up, very, very smart people, right? So the three things, right? Be realistic in how long it is taking you to raise money in this environment. You are probably not going to start from scratch and raise 10 million bucks in a month. It's not going to happen, right? You're going to have to knock on a lot of doors, and don't be discouraged. Then have your act together, okay? Make sure you've got answers to questions and have thought through your thing. And then, like I said, I think the final thing is just be realistic in what you're asking for. Doesn't mean give away the store. It just means, VC is not going to write you a check for $5 million and walk away with 2% of the company. It's not going to happen. And some founders spin their wheels a long time before they get to the realization that, capital means it's a ticket to the table.
Yeah. You're selling part of your company.
That's right. And, and I say all that too with the knowledge that it can be discouraging for founders to have to go into that environment. So, utilize the people around you, utilize friends, utilize founders that who have raised money, talk to them, find out who they knew. Don't be afraid to ask for help and ask for connections, because it does work.
What about the other side of the table? Or maybe not the sophisticated VC side, but what's your advice for somebody who's always wanted to invest in VC or has a chance to invest in a fund, as maybe just as an individual investor? What would you say to them? What should they know?
You have to be patient, right? So VC is a patient strategy. It is not a liquid strategy. You cannot use money that you're going to need, right? But it can be very rewarding. You can be part of something that grows to become a big deal. The other piece of advice is don't put all of your eggs in one basket. Don't make one investment, or if it's into a fund, make sure that fund is making many investments, because the hit rate on these is not very high. The ones that do hit might return 50x your money, but there's going to be 9 out of 10 that didn't. So you need to diversify and make sure that you're using capital that you don't need, right? Then the other thing I'll say is do try to do it, if you can, through a vehicle, some kind of pool, whether it's through a standing VC firm, or even some accredited investors create an angel pool and they form an LLC for that, right? And the reason why that's important is later on, when the company is doing successive VC rounds, the folks that are going to write those larger checks down the road after the company's growing and has got revenue and 50 employees and all that, they don't really love lots and lots of individuals on the cap table. They would prefer 4 or 5 entities. It's much easier, and it's purely out of self-interest. They don't care about anybody, right? They want to make it easier to raise successive rounds of capital. So what they really want is a simple cap table, 4 or 5 entities on it with which they can deal when they might need to cram down, or they might need to do a follow-on or some other round that requires, consensus amongst the group.
All right. Great advice. Stephen Lord, Burkland Associates. Good to see you, my friend. Let's get together in person soon.
You too, man. Thanks for having me aboard.
Before you go, please take a minute to subscribe to the channel and leave us a comment. I'm Ed. See you next week.